This stock has just been out of this world good over the last 5 years or so. It's returned around 515% over that time frame, and a lot of investors have wanted me to go over this for a bull versus bear case video, but I have kind of put it off quite a bit. And the reasoning for this is I did not think I could actually look into this company and compact it into a 5-minute time period, but I am going to take a stab at it this week. And the company I'm going to be talking about is Fairfax Financial. This is a Berkshire type company. There's a lot of differences, which I will go over in this video, so you're not going to want to miss out, especially if you're looking into owning either one of these companies. Fairfax is often dubbed as the Berkshire of Canada. So I'm going to go over that in depth. I'm going to go over whether or not I think the company is still a buy. And as always, everybody, before I start, I have that brand new report on the top holdings inside of my portfolio. You'll be able to tell if it's Fairfax or if it's Berkshire Hathaway, because I'll tell you right now, it's one of those two. I got that report down there. All of my allocations, my overall thesis on the companies, the biggest risks that they're going to go through over the next while. You can grab it absolutely free. It just takes a few seconds. And as always, I appreciate the support. If you'd like the video, subscribe to the channel, comment down below. Let me know what stock you want me to go over next. But let's dig right into it. So what is Fairfax Financial? Well, that's complicated to say because they are a very complex business model, which I will dive more into in the bear case, but they are often compared to Berkshire Hathaway, and for very good reasons. They're both led by value-founded investors, Prem Watsa, and obviously Warren Buffett. The primary model of the business is an insurance-backed business, and they utilize float to make investments. Now, one of the key differences here is Fairfax typically takes a much more aggressive and more of a trading style approach. Now, they paid the price for this heavily during the financial crisis, making a lot of defensive bets that caused them to underperform for a very long time, whereas Berkshire is more of that value-orientated buy and hold long term, ignore a lot of those macro calls and hedges, and just hold strong corporations over the long term. Now, again, if you're a big follower of Fairfax, you'd likely know the business is much more complex than this, but again, I'm trying to get this inside 5 minutes. Now, the bull case would be Prem Watsa. Now, he's no Warren Buffett. He's never going to be Warren Buffett, but he has been a very strong capital allocator over the years, which has ultimately helped the company's results, especially over the last half decade. When you run this insurance/investment style business model, you need somebody at the top who can make wise decisions, because ultimately, if you spend this money ineffectively, it will absolutely kill your business. They did so in 2008, which caused it to lag for the better part of a decade. But he is a very, very strong person to have at the top of the company. And again, a lot of people invest in this company because of Prem Watsa, and it is a viable bull case for owning this company moving forward. The second bull case would be the insurance segment. This is what is driving a huge, huge chunk of the business. They have combined ratios in the low 90% range, which compares the premiums collected versus claims paid out. You want to see this ratio below 100. Low 90% range is right up there with leading property and casualty insurers like Intact Financial, and its insurance arm is very, very profitable, which does allow it to take a lot of that excess capital and make investments. The third bull case would be book value growth. Fairfax Financial has a compound annual growth rate over the last 10 years on its book value of around 10%. And if we actually fast forward this to the last 5 years, it's effectively doubled its book value over the last half decade. It's a very strong sign that the company's acquisition strategy, the company's investment style is working. The other bull case would be the international diversification. Berkshire is more, they do have international exposure, but they're more North American based. The insurance segment for Berkshire is primarily located in developed markets overseas and in North America, whereas Fairfax Financial does have a lot of exposure to emerging faster growing markets. This does bring more risk, but this also brings more profitability to insurance areas that are underserved, I guess I could say. So I guess in a way you could say that Fairfax is more built for this type of environment over Berkshire. We have higher rates. We have a much harder insurance market, which ultimately leads to higher levels of profitability. And Fairfax tends to make much more aggressive investments than Berkshire, which tends to pay off more during rising bull markets, aggressive bull markets. Now, the bear case is the investment style. Again, Fairfax is much more aggressive. It made a bunch of plays back in the financial crisis in order to try and time the next market crash. And what it ended up doing is buying a bunch of deflation swaps, a bunch of equity hedges, which caused it to underperform for a very long time. If we looked at this chart, we're going from 2009 to 2020. That's a period of 11 years. Fairfax only returned around 60%, whereas the S&P went 250% and Berkshire went around 250% as well. So you can see what an aggressive investment approach can take if you're wrong, especially when you're a company that tries to time the macro trends, things like that, which they have mentioned they're not going to make that same mistake again. But ultimately, we have a founder-led style company here that relies a lot on them making the correct decisions. Now, the other bear case here is Fairfax tends to bet a lot on turnaround plays. We're talking BlackBerry, we're talking Molson Coors. These are not companies that I am particularly impressed with, and they do tend to take larger positions in potential turnaround plays, whereas Berkshire is more of a buy strong companies, hold them for the long term, and tends to avoid those weaker, poor performing companies. That's not to say that Berkshire doesn't invest in companies that do not do well, but it doesn't tend to take this turnaround approach for maximizing more returns. It's much more conservative. Now, the other thing is this is a very aggressively family-held company, so the plan for succession is not as confident, I guess you could say, as Berkshire Hathaway. Prem Watsa's son, Ben, now controls Fairfax India, but there's a lot of questions with their large amount of voting control, whether or not this is going to be kept in the family rather than just allocated to the best person possible to manage the company. Prem Watsa I believe, is in his mid-70s. He's got a lot more runway than Buffett did. I mean, Buffett ran Berkshire till his mid-90s, but there is an issue here for succession. The final bear case here is the insurance segment. Now, insurance has done very well over the last while. It's been a very hard insurance market, and if we do get it softening a bit, a lot of the tailwinds for Fairfax has been from their insurance segment, whereas Berkshire is more diversified. They don't have as much heavy reliance on insurance. They have the railways, they have the utilities, they have the manufacturing, they have the through the loom companies. We're talking, a lot more non-financial based holdings. So in the situation where the insurance market lags and financials start to lag, there is a good chance that Berkshire Hathaway, with its diversification, could perform better. Overall, I believe there is room for one of these companies inside of my portfolio. And if I were to choose one, I would choose Berkshire Hathaway all day over a company like Fairfax. I like the higher levels of diversification. I like the more conservative investment strategy. And overall, I just like the historical track record. The environment was absolutely perfect for a company like Fairfax to do quite well. The only difficulty here is it took a monumental tripling in share price for Fairfax to actually outperform Buffett over the long term. I do believe if the insurance market softens, if the bull rally we get in stocks kind of cools down, I do believe Berkshire is in a better position to drive long-term shareholder returns. There is more U.S. plays in Berkshire's portfolio, whereas Fairfax tends to take bets on turnaround Canadian plays. We're talking BlackBerry. I believe they recently bought Sleep Country for around $1.7 billion. I just like the way Berkshire operates more. That is not to say that Fairfax is not a high-quality company. If I were to buy one, I would buy Berkshire, and I do own Berkshire and plan to own it for a very long time. You will notice that this video is a little bit longer than usual, and that is because I could not get this comparison inside 5 minutes. I tried. It's just too complicated to get this one inside 5 minutes, but I hope you still enjoy the video. Head down below, like the video, subscribe to the channel. Let me know which one you own. Do you own Fairfax? Do you own Berkshire? Which one do you think will outperform moving forward? And as always, grab my 4 top holdings inside my portfolio. This is a brand new report we just published a few weeks ago. It is a great read, and you're not going to want to miss it. It's in the description. It takes a few seconds to sign up, and I'll see you next time for more great Canadian content.